Hi everyone, how are you? Are you ready to talk money? You ready to hear from the money panel today? Now, if you're not careful, you might wake up tomorrow finding that you've just raised $5 million in a new round, and kind of asking yourself, now that you've raised this money, what are you going to do with it? You have a little bit more dilution, but it's all for the good for local commerce. I'm really excited about this panel. We've got two partners from top-notch firms who are going to talk to you today, talk to us today about trends they're seeing, investments that they've made, all the different trends. So I think it's going to be really great. I think listening to the conference today and the agenda, I think it's safe to say that local is part of everything. And I think the gentleman from Yelp did a nice job talking about the $3 trillion in commerce and how local is part of all those conversations. Certainly these two will tell you that local seeps into almost every pitch they hear, especially on the consumer media side. So suffice to say, these guys see thousands of proposals, their firms, every year, and they may only do 5 or 10 deals. So it's a very select few that they back, but they've really backed a lot of winners. A friend of mine said to me the other day that local is like that little black dress. It never goes out of style, but how you wear it and where you wear it to changes all the time. So certainly a very trendy, so I can see some folks in the audience got that, and other guys are just like, what, a little black dress? But very trendy, but it's always a topic and always worth a listen. I think some of our friends at BIA Kelsey did some research recently trying to quantify in the last 2 years how many local deals there were. And I think they came up with $17 billion around funding of local kinds of businesses just in the last 2 years. So it gives you some kind of indication of it all. I'm going to let our panelists introduce themselves, starting with Sharon. She's a lead partner at Scale Venture Partners, and has been recognized by a lot of folks recently by the Huffington Post as one of the top 25 women in tech to follow on Twitter, and she's been very active on this. And then I'm going to turn it over to Alex, who's a partner on the far left at Bessemer Venture Partners, and he's going to talk to you about deals that he's done around Yelp and Yodel, and even before that, Alibaba. So a tremendous wealth. Sharon, do you want to kick it off and tell us a little bit about the firm?
So I'm a partner at Scale Venture Partners. I've been there since 2001, so been through a couple cycles on the venture side, and before that I have 2 past lives. I was a consultant at Bain & Company for 5 years, and then worked as an executive in the software space for a long time, including at a crazy startup in the 2000 timeframe that went public with a $4 billion market cap and less than $1 million in trailing revenue. So then it doesn't make Tumblr look so crazy. Our firm specializes in backing companies that are in the scaling phase. So early in revenue, still building the business. Companies that have achieved product market fit and early proof of a channel to market, and they're raising money really typically to spend more on sales and marketing, but they do end up growing a lot of different parts of the business. And then trying to grow big long-term companies that matter. We're really excited today and proud of one of our management teams. ExactTarget is one of our portfolio companies, and Salesforce scooped it up for $2.5 billion today. So we're really pleased for Scott Dorsey.
A very good day.
And let me say, they actually built that business in Indianapolis on $7 million of paid-in capital, got it to about $70 million in revenue, so it did an awesome job on that. Some of my local-oriented companies, just quickly, 2004, local internet marketing was a big theme for us. I made 2 investments in 2005. Merchant Circle, which is it's the biggest social network for local small businesses. It's over 1 million local small businesses, about 15 million monthly uniques. And then later that same year, a company called Reply.com, which is a performance-based marketing solution, all for locally targeted traffic. Later on, those 2 companies ended up merging, kind of independent of me. I was trying to keep them apart, but they were like this Aristotelian twins, in that one had a lot of traffic and one had great monetization, and they needed each other. And then I have another portfolio company in New York called Everyday Health. That's a big media company in the health and wellness space. They also have, because they have a ton of consumer traffic, a big business doing marketing services for physicians' offices.
Great. Alex?
Great. My name is Alex Ferrara. I'm a partner with Bessemer Venture Partners, and I'm actually based out of New York. My background, I started my career more as a software engineer, was a Java developer for many years, and then after a brief stint on Wall Street, after that joined Bessemer back in 2005. Bessemer, we were probably the longest standing venture firm in the US. We've been around for more than 100 years. Started as a family office, and for those of you who remember your middle school social studies, the Bessemer process was a process for mass producing high quality steel at low cost. It was very innovative in the late 1800s, and that innovation ultimately resulted in US Steel, which was the first, as I recently learned, first billion-dollar public company. So they took the proceeds, the Phipps family took the proceeds from that and started investing. And so today, we manage about $4 billion of capital. We're investing out of a $1.6 billion fund. We have offices in New York, Menlo Park, Cambridge, 2 offices in India, Israel. We just recently opened an office in Brazil as well. So we are multi-stage, and we focus on, and we're global. I think our heritage is very much early stage, so the majority of our investments tend to be Series A, Series B investments, and we've been fortunate in sort of those pursuits. I led an early stage investment in a company called Yodel, which is a local advertising business. I did not lead the investment in Yelp. My partner Jeremy Levine led the Series A in Yelp back in 2005. And then we also do a lot of growth equity investing, and so while a smaller number of deals, obviously much larger checks, and so we've invested in companies such as Box and Eloqua and Twilio. Actually, we started off as seed investors there and have invested increasingly larger and larger checks. And in terms of the local space, I invested in Yodel back in 2006, I think it was. I also made the first round of investment in a company called Shopify, which is an e-commerce platform that focuses on small and medium-sized merchants. It's a company based out of Canada. And local has historically been a very big area of focus for us. We tend to be very roadmap-driven in our investment approach. So we have about 24 active roadmaps across our firm right now. And back in 2005, we really started this investigation of local, and that's evolved over the years, and we'll talk, have sort of more into focused on verticals and then focusing on different sort of ways of leveraging mobile devices. But it remains a really sort of strong investment theme across our firm and obviously across many other venture investors as well.
Well, that's great. Well, let's talk a little bit about the processes that both of you and the firms go through when you're looking at someone who's coming and looking at the local space. And Alex, just to follow up, talk to us a little bit about your roadmap process, because I think some folks think that somebody has a great idea, they approach, they know someone, and they make a pitch, and it might be an aha moment, and they say, well, you might say that's a great idea, let's invest in that. Can you both kind of talk a little bit about kind of the process and how you get to some of those decisions when you evaluate?
Sure. So the road mapping process within our firm, and taking a step back, I guess, just to be sort of intellectually honest about it, I think there are a number of cases where we are very focused on the roadmap, and there certainly are cases where we've been a little bit, we've done some back fittings, so to speak.
Open to serendipity.
Yeah, exactly. Yeah. And so I'd say maybe half of our investments will come from that road mapping process, and then the other half will be more opportunistic. But in terms of the road mapping, what we tend to do is we'll try to look at areas of the global economy where we think we will see tens of billions of dollars of value creation over the next 10 or 20 years. And then we'll try to understand the value chain in those particular areas, try to understand how the trends are affecting that value chain, and then try to map out what the landscape looks like today and what we think it might look like in the future. And then we go through a peer review process internally where we'll present it to our partners, and a lot of the time we'll decide it's a bad roadmap, and we'll decide not to pursue it, and other times we decide to move forward on it, and that could result in one investment, it could result in 5 to 10, but that's kind of high level how we tend to approach it.
Yes, I think the process is very similar for us, and I'll just maybe make a couple of other observations on it. It's a little bit iterative for us, feeling our way through, we call it a megatrend or pervasive trend process, because you're always wanted to be open to new facts. So we're really, first of all, trying to identify, just a couple of handfuls. Usually we're working about 10 mega trends that we think are going to be pervasive across the technology landscape and across the IT buyer landscape. We only do software investments in the US, so cloud, SaaS, internet, and mobile. So we don't have to be covering the entire technology landscape, but what we're looking for is trends that really, that propagate opportunities across those 4 categories of software companies and also across the kinds of buyers. So we think about consumers, line of business executives, and IT buyers as having kind of different motivations. But we're, again, trying to really understand at a granular level what's going on with trends, disruptive, either technology trends, things, it might be solid state storage or the rise of social connectivity, connected camera devices, things like that, that will transform lots of different businesses. So we understand the fundamentals of what's happening from a technology standpoint, and then how they're going to affect each of those buyer communities. And what we're really, the way we think about it is we're looking for big emerging kind of white spaces in the market as trends happen and the continents have continental shift, where is there a rift in the market that's someplace where startups can get differential scale and profitability over the long term? Because you're really looking for parts of the market that are uniquely accessible to startups and that maybe incumbents would have a hard time serving. It's part of why we have a very long history in software as a service, and we identified early on it was going to be very difficult for incumbents who sold premise-based software licenses, recognizing all the software license up front, to make a shift in a business model. And so because of that, their innovator's dilemma, it would allow startups to get a lot of scale, even though traditional software companies had a lock on the channel to market. And you saw, the Oracles and SAPs add on lots and lots of feature functionality to take to their customers.
And so, let me alert the audience. So we're going to try to take questions after some of these topics that we do. So please think of questions, because we're going to ask you to ask some of these questions as we go forward. So Sharon and Alex, great. So megatrends is what we're seeing around the scheduling and the SaaS for a lot of these. So Alex, Yodel, obviously, which you were an early investor in, started out as a reseller, but obviously is doing, well, like a lot of companies, is moving more towards CRM and SaaS and scheduling. And obviously, Sharon, you've invested in a few. Is that a mega trend? Is that a trend that has a lot of life to it, or is it a Me Too kind of situation?
Well, we hope it's a trend that has a lot of life to it. Certainly in the case of Yodel, they've moved from historically, being a media company and a reseller to some extent to having a broader software platform that they can sell into both local businesses as well as national accounts. And I think independent of that, so Yodel was an investment that came out of this local roadmap back in 2005, and then a couple of years after that, we started thinking about what would the next wave look like, or what were some of the sub themes that we thought we would see, and scheduling was another one, and that I think it was this view that consumer behavior was changing, and that consumers were increasingly spending time searching for resources online. They were using mobile devices, and so it was fairly straightforward. But our view, and it led ultimately to an investment in a company called Mindbody, which is a company that provides scheduling software for yoga studios and salons and spas, and then another company called Xtime, which we more recently invested in, which is focused more on the auto industry. And our view was that scheduling was really the entry point, and it was the kind of the thin edge of the wedge that would allow these businesses to offer a broader set of CRM capabilities. And I think it was both a view that the merchants, it was something that was easy for the merchants to get up and running and started with, and that over time they would get increasingly comfortable with these types of offerings, and the merchant engagement would increase, and then simultaneously on the consumer side you'd start to see increasing levels of engagement as smartphone penetration increased. So that's so far seems to be working out quite well. Both of those companies seem to be doing quite well, but we continue to look at that sort of theme of in individual verticals, what are the trying to really dig deep into a vertical and understand what is the workflow, what are the use cases, what's the consumer behavior, and often we're willing to start with what may seem like very simple types of product offerings in the hopes that they can really expand that over time to offer a broader CRM solution or workflow software as a service solution.
Yeah, I think just Another way to think about the opportunity here is there's just a ton of friction. There's a ton of business that happens in local, right? The Yelp comment this morning about the $1 trillion of commerce. It's really high friction kinds of commerce that happens. You know, venues are only open certain hours. Sometimes your inventory is in one spot, not another spot. People are busy, can't pick up the phone. And there's also, most of these kinds of investment opportunities are in some form of a two-sided network. You have to have lots of merchants involved and consumers. And you need both of them interacting in order to make the company be successful. So there's great investment opportunities in software solutions that provide delight on kind of both sides of those networks, whether it's, you know, making it a lot easier to schedule something instead of me having to call my doctor, you know, during the hours of, 10 a.m. to 10:05 when they might be available to answer the phone. It's harder than getting into the French Laundry, or trying to figure out where is that merchandise. I mean, I had this horrible experience this weekend trying to buy a dress I wanted, was sold out online, figured out maybe it's in one of the brand stores, but then the brand stores aren't connected. You have to call them all, then they're not all open on the same day, and you go like, WTF, I want to give you money for this thing, why don't you just take my money? So I think those kind of, that's just an example of the kind of friction that exists in serving a locally oriented business, but that technology solutions can help smooth and increase the velocity of transactions and help make money for everybody in the meantime.
So I think that's great. So is your first inclination to say, if somebody comes to you and says, okay, scheduling, you're going to do scheduling, great, CRM, do you say, hey, start with the vertical? Because really we've seen the proliferation of sites and businesses that are very vertically focused, and obviously they're inherently local, but they're kind of staying in their vertical. How do you see, kind of winning in a certain vertical versus kind of pigeonholing yourself too soon? Sharon?
Yeah, maybe I'll just say, so, again, abstract. In software, in general, there's this kind of long-term architecture that says you have some sort of platform technology, but very few customers actually buy a generic platform. They want it to be able to do something, so most platforms have a vertical instantiation of them that lets them get traction someplace to start with. And I think that's similar in local as it is in almost any other part of the software ecosystem. But then if it's deeply vertical, you have to make sure that it's a big enough vertical that the company can gain sufficient scale to be a meaningful business there. It's also important in the go-to-market process, just as it is in traditional software. A lot of go-to-market for web-based businesses is around content-based marketing and being found organically, right? Because you don't want to have to, pay to get every customer. And so that's often, so you have to figure out what are people going to be looking for. And, very few people, I would posit, go on the web and think to themselves, I'd like to look for some scheduling software and maybe a scheduling site, and maybe that will provide me access to scheduling my yoga appointment this weekend. Or maybe they actually go and say, I want to go to a yoga class. How do I get a yoga class and land someplace where they can make an appointment? So that being vertically oriented also helps the customers find the merchants who are in the end, the ones who are paying for the software.
And so let me pause there. Some questions around this scheduling verticalization of local. Obviously, it's a theme that we've talked about a lot today in the last year. Some questions on that? Yes. Say it a little louder.
Can you hear me well enough?
Yes, it's getting better. They're going to bring you a mic too, so why don't you wait for that?
This will do it. So it's kind of a two-part question. It seems to me that investing in local has always been a challenge. It's a difficult place, and I'm curious if you have some lessons you've learned in your experience. And it kind of leads into the second part of the question. Obviously, the approach that investors have taken to the market has evolved over time. How is it evolving now? Thanks.
Good question.
Yeah, that's a great question. Gosh, yeah. So it can certainly be challenging. I think to take the second part first. I think from what I've seen, looking at talking with other investors and looking at even our own internal process, I think we've gotten much more metrics oriented, and I think it's probably the same way that in the software as a service, the enterprise SaaS space, companies these days are very focused on a set of metrics, and my firm has done a lot of work in this particular area. We tend to be very focused on what are the unit, depending on the business, but especially if it's a company selling into merchants, what are the unit economics, and what's the customer acquisition cost, what's the churn, what's the lifetime value, and these are obvious things, but I'd say that we've probably gotten a little bit more systematic and rigorous about really trying to understand what those unit economics look like, and then benchmarking them against both our portfolio as well as publicly available data. And I think that's really proven to be probably a first pass filter in many respects. So sometimes we might have a great, an individual investor might have a great deal of conviction around one particular area, and they might be willing to invest very early as a result. But I'd say for the majority of the opportunities that we look at, the first pass filter really is, do they have enough traction that we can start to see what the unit economics look like? Do we have enough data points? What's the uncertainty around those sort of metrics? And then what are the levers, the sort of knobs and dials and levers that the business can sort of experiment with to try to figure out how to improve that over time? And so I think that's definitely a sort of a theme I've seen within my firm, and I think among others. And then in terms of some of the challenges, I think local churn for merchant-oriented businesses is incredibly challenging to deal with. From what I've seen across both private and public companies, that's sort of a challenge that just recurs across many businesses. And then I think the other thing that we often we always look for or frequently look for in businesses tends to be consumer adoption, consumer engagement. And so I think we see a lot of businesses that are look like they're getting the flywheel spinning when it comes to selling into merchants, but getting that consumer adoption in local, I think, is incredibly challenging, because by definition these markets are local, and so there are just a very small number of companies in the last 5-10 years or so that have really been able to to sort of figure out that consumer engagement, consumer adoption sort of piece of the puzzle. And so we're always sort of on the lookout for signs that somebody's figured that out, and I think as a result we often will track, there's sort of a number of businesses where we will see an entrepreneur has a really interesting approach to the market. It may not be working yet, but we think, gosh, if it does work, it could just take off really rapidly. And so there are kind of a set of companies or areas that we track very closely to try to see if we can find signs, sort of glimmers of hope that someone will kind of crack the code on scaling consumer engagement, either in a horizontal fashion, which I think is very difficult, or or in a vertical, which I think we see a little bit more frequently.
Sharon?
Yeah, maybe I'll just give a little bit of historic perspective. So, actually both of us said that we started our roadmaps in local in the 2005 timeframe. So you can think that was, number one, it was just past the Google IPO. Google was, of course, already quite large by that point, but they only had 200,000 total advertisers worldwide, where there are 20 million small businesses in the US. So the penetration of, buying, and Google, of course, had the vast majority of all the money that was being spent advertising on the web. But they had tiny, tiny penetration among local small businesses. And what you saw in that first incarnation tended to be companies that were relatively brute force, meaning they fielded large field force because they were copying a Yellow Pages feet on the street model, reselling Google traffic packaged to small businesses to make it easier for them to manage their web presence. And that's how you saw companies like Reach Local come up. And Reach Local reached very large scale, but not very large margin, and now they're figuring out, they're trying to figure out something else that will earn them more margin than just passing through markup on Google sales. Now what you're seeing, that era is done. In the 2005 timeframe, I think we identified something like 75 deals that got venture funded in that year, and we did 2 of them, you did a couple of them, they were all nameable. Very few of them got to scale, except Yelp. And I think one of the things you see about the companies that were successful that came from that era or shortly thereafter actually was verticalization, but of web traffic. So Yelp, which started in restaurant and bars, Zillow, Trulia, both of which I would count as local business, as serving local businesses, but deeply vertical with really great consumer value proposition that then they turn around and monetize by the merchants.
So I think, given there's still, and I think it's a great point, that there's still a lot of fragmentation and there are few companies that are really kind of owning certain verticals, what are your roles, and Sharon, you had both Reply, Investment, and Merchant Circle, and of course you're not taking credit for bringing them together, but I'm sure, what about consolidation? Obviously we're seeing lots of these segments in quote-unquote local have lots of consolidation. Do you guys, maybe talk a little bit about your firms when you're looking at investment, meaning coming from TPG and a private equity, it's all about consolidation. It's also all about picking a market and buying a few companies and putting them together and getting the right management team. How do you guys see it? Alex, is that something you're looking for when you're looking at an investment to say, who can I pair this up with and consolidate to get a much bigger share of that market?
You know, I can't say that it really is a big focus or something we spend a lot of time on in the local space per se, and you know, maybe we should be thinking more carefully about it. But it's not an area where I think we've, unlike some other industries, there aren't so many natural synergies, either revenue or expense. But you know, and so it just hasn't really been a big area of focus for us.
I'll actually say the opposite, which is for us, for many of our portfolio companies, M&A is a very active part of their later life cycle. So, because you're trying to invest in big long-term companies that matter, right? Box, we share Box. We invested in Box the year it did $4 million in revenue. It's now done a series of acquisitions. So it is a big center of gravity itself. It's adding tuck-in acquisitions. Reply built itself through numerous M&As. Usually in technology, you're not doing, it's very different than private equity. Private equity, you think classic roll-up. That's where you're jamming together a bunch of companies that are kind of similar, stripping out a whole bunch of the overhead expenses and hoping that together the things you've put together are making a lot more margin, covering about the same G&A as one of them, and therefore it's more profitable, and by the way, then you can load it up with debt and do a dividend recap. It's a really different way of making money than the venture business, right? The venture business is trying to build a company that's going to continue to organically have a really high revenue growth rate and profit growth rate, even at the $100, $200, $300 million in revenue run rate business, because that's when we're going to exit it when it's public, and you want it to have a very strong PE multiple even when it's there, so that we can get a big return. So you're really looking for a company that can be a center of gravity, and then keep doing those tuck-in acquisitions that are going to give it additional product lines, additional value for its customers, not a lot of additional expense, and provide a lot more market size runway to the company so that it can keep scaling and be worth a lot of money.
Great. A large part of this conference is hyperlocal, and obviously we've seen over the years a lot of very broad plays around geography, with whether it was Microsoft Sidewalk or AOL Patch. Recently, earlier this year, we saw Nextdoor come out and get obviously last year, but get another $21 million led by Greylock. What are your thoughts quickly about this kind of broad kind of, I live in this area, and it's not really a focus on a vertical or a platform. I mean, it is a platform, but it's much more of a broad play. Is there still an appetite from you guys to fund those kinds of broad, very hyper-local enterprises?
You know, they're very hard to scale, because you have to be broad, but you also have to be deep in thousands of locations, right? Meaning not San Francisco, but Pac Heights and Dogpatch and downtown San Mateo differently than the Highlands. So I think one of the issues with these companies is getting enough action in each of the hyper-local locations to actually make it worthwhile for those people to keep coming there, rather than having to reacquire them from the top every time. I mean, that's my worry on the space. I mean, I was actually just doing something, setting up a Twitter feed today for a sports club I belong to, and went and did a bunch of searches and found a really cool article on Redwood City Patch about something happening right next to us. But I don't know that much happens in the Port of Redwood City, that I would need to go there every day, nor that there's that much commercial opportunity for it. And Nextdoor is very interesting and kind of an opportunity to replace the listserv for your street, right? I mean, my street has an email D list. We're all on it. We email each other frequently. But I'm not sure that that's a business, kind of the same way that Yahoo Groups hasn't really been a business for decades.
Alex, what do you think?
Yeah, I think it's incredibly difficult, but I think it is an area that we're interested in and we're watching closely. I think we think that someone will build a really interesting big company in that area. We've seen a couple of different approaches. I think one of the ones I've found to be perhaps most interesting is sort of the intersection of sort of open government with hyperlocal, and so increasingly, and we see this in New York quite a lot. Governments are making data available, and you're seeing communities that are sort of forming in an ad hoc way around particular issues, and there are companies that are innovating around that. I mean, there's one in New York that I think is pretty clever that just it's a mobile application where they allow you to report potholes, right? And so you walk, there are always people in your neighborhood who have nothing better to do than to report every pothole that they see, and that becomes a call to action for others in the neighborhood. And when you think about the ability to implement sort of many of the social and community features that you found in other areas of the web, whether it's Reddit or Quora or Twitter, bringing that, kind of combining that with mobile and open government, I think creates some really interesting. It's almost kind of kindling. Something may emerge there, and I think the notion of sort of building local communities around some of this open government data, and then moving more towards questions of when's trash day this week, or where's the Memorial Day parade path this year? I mean, there are all these kind of local questions that I can never get the answers to them. It's just so challenging, and I think there's something in that particular sort of that combination that I think has the potential to really emerge as something that could really scale, almost like a sort of Quora or Stack Overflow kind of model across hyperlocal geographies.
Yeah, it's an interesting point, because there with open government, there's a point of leverage to reach more people and get more people to adopt. I mean, I think that's a really interesting observation.
That's great. Let me open it up for questions. I know time-wise we're hitting it, but because we've heard a lot of really cool things. Yes, please, in the center.
Yeah, my name's Pat. You guys mentioned some trends and roadmaps, and you touched on a few of them, but love to hear what you guys see over the next couple of years as being some of the more major trends that are taking hold in local.
Great question. Well, Sharon, I know we were talking about the gamification of local, which I think is worth a good article. What do you want to talk a little bit about that? Is that a major trend?
I mean, so first of all, you had the whole Foursquare, which was a game without really a point except to be the mayor. But there are a lot. I think ideally what you're looking for is multiple trends coming together. And people, what Lem and I were talking about at lunch was actually not so much gamification, but actual games that take place in local space, meaning as opposed to you're playing a game in a virtual world on your phone, you're using your phone to play a game in real world space that includes, some kind of quest or something like that. So I think that the interaction of consumers with their phones in local space still has so many things that are unsolved, plus there's all this, chatter going on right now, of course, about Google Glass. So that, whether you're looking at augmented reality, which personally I don't, buy into as a near-in thing that people are going to do a lot, but the fact that you've got a camera, which is also a scanner, a data input device, communication modality, with you all the time, with your true location, I just think is very interesting. And you're starting to see some commerce opportunities around that. For example, Neiman Marcus is on the forefront of merging online and offline behavior and taking your, when you walk into the Neiman Marcus store, there's a little plaque on the side. If you notice, it says, we'll be using your phone to tell where you are. And what they're doing is merging your in-store behavior with your online shopping behavior and trying to figure out what departments do you go to more often in the store versus online, how can they cross-sell you things. So I think that kind of stuff, the sort of merging of the location information from your phone with lots of other activities is going to be a fertile area.
Well, great. Well, thank you. I think we've reached the time. Please join me in thanking Sharon and Alex for their insights tonight.